Okay, let's do some transaction identification. And here's how the process works. Things go on in a business and we have to actually recognize a business transaction. And it's something where either our assets, liabilities, or owner's equity of the company have changed. It has to be measurable in terms of money, and then we can record that particular business transaction. So here's a couple of just real quick ones that we can look at. If we purchase a computer, think about, is the company's financial position, meaning are their assets, liabilities, or equity changed because of the purchase of a computer? And the answer is going to be yes. Our assets are actually changed because we're going to bring a computer into the business, which is something we own. And then more than likely we're going to have to pay cash for that, which is also an asset. So that is a recordable transaction, and we're going to have to look at how a company's financial position is changed, so how the basic accounting equation is changed. Now, if an employee answers the telephone, you might say, is that something that's considered a transaction? And the answer is no. Until the assets, liabilities, or equity of the company is changed, it's not a recordable transaction. Maybe it's her boyfriend on the phone wanting to know what she wants for dinner. So we wouldn't record that. Here's another example. If we pay rent, is that something that's recordable? And yes, it is, because the company's equity, rent expense, is going to change, or ultimately their equity, and then their asset, cash, is going to go down. So we're going to do about 10 or so more of these, and let's see what happens again in terms of this basic accounting equation. So if J. Scott invests $20,000 cash to start the business, we have to figure out what happens in terms of the basic accounting equation. And let me tell you something up front that's very important. At least two items within the accounting equation, or at least two different accounts, need to be impacted with every transaction. It's because it's a balance, and our items need to stay in balance. So I thought this image comes to mind when I say balance. So you may remember all as a kid playing on a teeter-totter. And if you think about assets being on one side of the teeter-totter, so we can have our assets on this side and then our liabilities and equity on this side. So with every transaction that we do, this has to stay in balance. It has to stay equal. So back to the question at hand. It says J. Scott invests $20,000 cash to start the business. So we can stop right here where it says invest $20,000 cash. That means the business is going to take in $20,000. And if the business is going to receive $20,000, we have to think, well, what kind of account is cash? Is it an asset, a liability, or an equity? Is it something we own, something we owe, or the difference between the two? And cash is an asset. So our cash is actually going to go up by $20,000. Now, in exchange for that investment, J. Scott, he is going to get common stock. So my stock is also going to go up by $20,000. So let's look at the next slide. It's a little bit cleaner than my chicken scratches here. So we've got our basic accounting equation again. Assets equals liabilities plus equity. So cash goes up $20,000. Common stock, which is equity, goes up $20,000. And my accounting equation stays in balance. I've got $20,000 now equals $20,000. All right, let's do the next one. Now we purchase supplies paying $1,000 in cash. So again, we have to figure out two things are happening here. We bought supplies and we paid cash. So if we buy supplies, what kind of account do you think supplies are? Something we own, something we owe, or a difference between the two? And supplies are an asset. So our supplies are going to go up by $10,000. I'm sorry, $1,000. But we paid cash for those supplies. And again, what kind of account is cash? Well, cash is also an asset. So anytime we pay cash, our asset, cash, is going to go down. These two will offset each other. One goes up, one goes down. So the net effect is going to be 0 on our accounting equation. We stay at 20,000 equals 20,000. But the components of my assets have changed now. You can see I have $19,000 in cash rather than 20, and I have $1,000 in supplies. Those two added together give me 20,000. And of course, nothing happened to the other side of our accounting equation. Here we go. We've purchased equipment for $15,000 in cash. Again, let's think about what's happening. At least two items are going to be impacted. this case equipment and cash. We purchased equipment for cash. Well, we paid cash for our supplies a minute ago, and we know that had the effect of taking my asset cash down by $15,000. Now, in exchange for that cash, what are we getting? We're getting equipment. And equipment, is that an asset, a liability, or equity? Equipment is an asset. It's something we own. It has value. We can sell it at a later time. So my asset, equipment's going up $15,000. And just like before, all of our transaction happens on one side of the accounting equation, but they do balance each other out. Sorry. So our cash goes down. We now have a $4,000 balance in cash. We still have $1,000 in supplies, but we have $15,000 in equipment. That's a total of $20,000 for the asset side. And again, nothing's happened yet on our equity side. Here's another example. We purchased supplies of $200 and equipment of $1,000 on account. Purchase supplies of $200. Okay, so if we're going to purchase supplies of $200, think back to what we just did a minute ago. What kind of account are supplies? Supplies are assets, so my asset supplies is going to go up by $200. I also purchased equipment of $1,000, and again, think back to the last transaction. When we bought equipment paying cash, my equipment went up $1,000. Now what's different here is we're purchasing this on account. We're not paying cash. We're going to pay for it later, and we call that a liability. Now it's something we owe, and it's going to be accounts payable. So my accounts payable is going to go up, which is a liability, for $1,200 for the $200 in supplies and the $1,000 in equipment. And again, you can see where we've added those here for transaction 4, and my liabilities have gone up. My equation, my accounting equation still stays in balance though, because I added $1,200 to the asset side, and I added $1,200 to the liability side. Now we borrowed $4,000 from First American Bank. Okay, we borrowed $4,000. Well, if you've ever gotten a loan from the bank, when you go in to sign the paperwork, they give you a check. And what are you going to do with that check? We're going to deposit it. So my cash is going to go up. And again, remember, cash is an asset for $4,000. Now, in exchange for that cash, what's happening? I now have a liability. So my liabilities are going to go up. In this case, notes payable. The bank's going to make you sign a note. It's going to have interest. It'll have a due date attached for $4,000. Okay, we'll go to the next slide. So you can see here now my cash went up $4,000. That's good because we were getting a little low. And my liabilities, now I have two kinds of liabilities, accounts payable and notes payable, have both gone up. And then my common stock is still staying there. But my accounting equation stays in balance. So it looks like we're doing a good job keeping everything in balance. Now we provided consulting services receiving $3,000 in cash. Again, anytime we receive cash, that should be a quick indicator for you that my asset needs to go up, and in this case the asset is going to be cash for $3,000, and in exchange we provided consulting services. Well, how does a company make their money? This particular company provides services. We're going to call that revenue. So my revenue is going to go up $3,000, and revenue is part of stockholders' equity. So my assets are going to go up as well as my stockholders' equity for $3,000. So you can see here cash has gone up again. Now my assets on the asset side are $28,200, and my revenue, which is part of my equity, has also gone up $28,200. This time we're paying salaries of $800 to employees. Paid salaries of $800 to employees. So anytime we pay, we know our cash is going to go down. Cash is an asset, something we own, $800. Now, our expenses are actually going to go up for $800, our salaries expense. However, expenses decrease my equity. So for my accounting equation, my equity is going to go down. Let's show you here. So my assets are now at $27,400, and you can see here my expenses decreased my equity. So my liabilities and equity side now goes to $27,400. Just a couple more here. Oh, maybe just one more. Dividends of $500 are paid to shareholders. So again, paid. Anytime we pay, that should be an indicator that my cash goes down, which is an asset, $500. And this time, we're not getting something like equipment or supplies, but we're going to pay dividends back to our stockholders. And again, look at what's happening here. That's a negative. That reduces my equity. So even though my dividends are going to go up $500, that increase in dividends actually decreases my stockholders' equity, as does the payout of cash. So when we're all said and done here, here's what happens. You can see we have 3 different kinds of supplies totaling $26,900. We have 2 kinds of liabilities, and we have common stock, dividends we paid, we received revenue by providing a service, and we paid out expenses. And so the liabilities plus equity side is now $26,900. Those also stay in balance.